Hello everyone, good morning, good afternoon, good evening, in whichever time you are listening this video. Hope that your preparations are going well. So in this video, we are going to discuss about the completion and review chapter of ACCA paper number F8, which is Audit and Assurance. Completion and review, very important chapter and very sensitive chapter where there is a lot of possibility of misunderstanding. Okay. So please listen very carefully, try to understand the meanings of the different concepts that has been involved here, and we'll try to ensure that the concepts are made very simple for you. Okay, so try to understand the logic behind all these discussions. Now see, for particularly for this chapter, you need to also have the knowledge of your financial reporting, subsequent events, going concern concept. Okay, so the knowledge of those topics are also very much required. So let us try to discuss in a very simplified manner. So first we'll discuss the concepts and then we will look into the topics, I mean the text that has been given in your material. Okay. Now coming to the importance of this chapter, it is a very important chapter. All the three standards that has been mentioned here are very important. That is your subsequent events, going concern, and then written representations. All the standards are very important from the exam point of view. Please do not miss this video. Listen very carefully. See, the text anyway, it is there in the material, you can read it, but the concept behind that, the logic behind that, you cannot understand it. But if you listen carefully, you can easily remember the concept. Once you listen my video and then you read the text, easily you are going to understand it. Now if you face any difficulty, if you have any problems, please do mention that in the comments. In my earlier videos also, I did not get any comments, uh, but you started watching it but you have not given any comments. Please subscribe the channel so that it will give me more motivation to bring more and more videos for every attempt. Okay, so let us begin with this video. So see, this chapter heading is completion and review. The chapter heading is completion and review. See, completion and review happens a step before your audit reporting happens. Okay, first this completion and review will happen, and then at last final stage is your audit reporting. Now, some instances, some matters that are required to be focused upon at this stage are subsequent events, in the going concern, and the written representations. Okay, now the standards that we are dealing with here is the ISA 560, which is talks about subsequent events, and ISA 570 talks about your going concern, and ISA 580 talks about your written representations. Now let us start with the first standard, that is our subsequent events. Okay, this is our first topic that we are beginning with. Now before we go to this standard, you need to understand some concepts from the accounting point of view. Okay, so that is nothing but your concept of subsequent events. Okay, or the events occurring after the reporting period. Now listen, there is a little bit difference between the subsequent event meaning as per the accounting standard and as per the standards on auditing. Now please try to follow the timeline that I am specifying here. Okay, listen carefully. See, first and foremost, financial statements are prepared, and after they are prepared, it is given to the auditor. Sorry. So board of directors approve financial statements, and after this stage it is given to the auditors. So auditors are going to conduct the audit and the auditors are going to give the audit report, right? And after the audit report, this audit report is circulated to stakeholders, right? And after this AGM will happen. Okay, AGM is going to be conducted. See, these are the timelines, you should remember. Now let us go to the meaning of subsequent events. Okay, now what is a subsequent event as per the accounting standard, and what is the subsequent event as per the audit standards on auditing? Okay, see, as per the standards on auditing, as per the standards on audit, those events that occur after the reporting period. Okay, see here it is called as a reporting period. So the events that occur after this reporting period and before the auditors report, okay, those events that happen in this period are named as subsequent events. Okay, so these are called as subsequent. Those events that happen after the reporting period and before the date of auditor's report is called as subsequent event. But whereas coming to the subsequent event or the events occurring after the reporting period, definition as per the accounting standard is those events that happen after the reporting period but before it is approved by the board of directors or the concerned authority approval is called as subsequent events. Subsequent events as per IFRS. Now you please try to understand the importance of this. Please try to understand the importance of this. See, if the events occur after the balance sheet date and before the financial statements are approved, now those events will be classified into two categories. You would have learned about adjusting events and non-adjusting events as per accounting standards. है ना? So if they are adjusting events, the relevant adjustment is required in the balance sheet and the profit and loss account or the notes to accounts. And in case of non-adjusting event, the board of directors need to think whether any relevant disclosure is required as per the relevant standard or simply they can ignore it. Now if the disclosure is required, then they need to mention that in the notes to accounts, otherwise they can skip it. Right? Now this should be done by management. It is a responsibility of the management to identify subsequent events, classify the subsequent events into adjusting events and non-adjusting events, and then if those adjustments those subsequent events require any correction in the financial statements, then it has to be corrected first. Okay, so it is not the responsibility of the auditor to do the correction, it is the responsibility of the management. Have you all understood this point? Now, auditor's duty is to check whether these subsequent events, whether has been identified, whether they have been accounted, whether adequate disclosures has been made or not as per the accounting standard. Okay. Now, if the changes are made by the management, then what is the consequences? And if the changes are not made by the management or the subsequent events at all not identified by the management, then what are the consequences? How the auditor should proceed with his audit report has been specified in this standard ISA 560. Have you all understood my point? So before discussing the auditor's responsibilities as per the standard, first we need to discuss what are the subsequent events, what are called as adjusting events and what are called as non-adjusting events. Okay, so I guess already we'll be having a good knowledge over this, so I am quickly running on to the point. So what is called as an adjusting event? Those events, those subsequent events which have a condition related to the circumstances existing as on the balance sheet date, which means event happened after the balance sheet date, but whatever the event has occurred related to that event, the conditions are existing as on the balance sheet date. In that case, it requires an adjustment. For example, say provision for bad and doubtful debts. Sorry, not provision, bankruptcy of a debtor after the balance sheet date. Now see, bankruptcy happened after the balance sheet date, but the condition for the bankruptcy, which is called as the debtors, are existing as on the balance sheet date. You are telling the shareholders that, see, as on the balance sheet date, this much debtors are there, which means I will be getting the money from the debtors after the balance sheet date. But suddenly you identified that after the balance sheet date, so and so amount is irrecoverable. Now, whenever it is irrecoverable, how can you show as on the balance sheet date that you are going to collect that money? Isn't it? Since you are not able to collect that money, you need to specify that in the financial statements. So, you need to adjust the debtors and the bad debts accordingly, provision for bad debts accordingly, isn't it? So, that is the reason why they are called as adjusting event. Event happened after the balance sheet date, no doubt in that. But the conditions are there as on the balance sheet date. Okay, like for example, say a subsequent purchase of a machinery after the balance sheet date. Okay, now as on the balance sheet date, you did not mention in the balance sheet that you have a asset, right? You don't have a asset, you would have done the negotiation, the asset would have come after the balance sheet date, so it will be a subsequent event only. But as on balance sheet date, if the equipment value is very high, you need to disclose that, isn't it? So it is not adjusting event. Have you all understood the difference between adjusting and non-adjusting? For non-adjusting, as on the balance sheet date, there will not be any condition. Okay, whatever information you are showing in the balance sheet, profit and loss account and notes to accounts are true. So it doesn't require any adjustment. But in case of adjusting events, even though event happened after the balance sheet date, the condition will be existing as on the balance sheet date. So they are called as non-adjusting events. Right, hope that you have understood this. Quickly we'll go through our material and we will see, yeah, what are adjusting and non-adjusting events. Okay, now anybody remembered IAS 10 events after the reporting period? Okay, so the events has been classified as adjusting and non-adjusting events. Coming to the adjusting events, these are the events relating to the conditions that is existing as on the reporting date. Okay, so as on the reporting date there are conditions, so they are called as adjusting events. Now adjusting events means what should be adjusted? Your balance sheet, profit and loss account, notes to account should be adjusted. Okay, so there are some examples like allowances for the damaged inventory and amount received or receivable in respect of insurance claims which were being negotiated at the reporting date. The determination of purchase or sale of a non-current asset. The determination of purchase or sale price of a non-current asset purchased or sold before the year end, agreement of a tax liability, discovery of errors or frauds after the balance sheet date. All these are the examples of what? Adjusting events. Okay, see, this is very important. In the exam also you may be asked to write these examples, so you need to remember this. Okay, so you need to write the meaning and you need to also write the examples. So remember all the examples, it will be useful for your FR as well as audit. Okay, in both the subjects it is a very important topic. Okay, let us continue. And now comes our non-adjusting events. So non-adjusting events means what? The events concerning the conditions which arose after the reporting period. If material disclosure is required, otherwise not required. Which is as on the balance sheet date there is no condition for adjusting those transactions. Okay, so some of the examples here that has been given is the issue of new share capital or the loan capital, major changes in the composition of the group. It happens after the balance sheet date. In that case it will be a non adjusting event only. Okay, next, losses on non-current assets or inventory as a result of fire or floods. Next, strike or government action such as nationalization, purchase or sale of significant non-current assets. If it is see, if these are done after the balance sheet date, then they are non-adjusting events. Now listen carefully. I already said you it is a responsibility of the management to identify the event, determine the event whether it's adjusting or non-adjusting, and then accordingly do the adjustment or mention a disclosure as per the applicable financial reporting framework. Now what is the auditor's responsibility? Auditor's responsibility depends upon the situations. Auditor's responsibility what? Depends upon the situation. Very important. Very important. Listen very carefully. Listen very carefully. Now in the first situation they are saying that if this information is known to the auditor, see, let us go back to our discussion. Let us go back to our discussion and listen carefully. Now I said that these subsequent events should be identified by whom? Management. Should be informed to whom? Auditor. Okay, management should identify it. Management should do the accounting accordingly and then inform the auditor about this. Have you all understood this? Now, will the auditor need to consider all the subsequent events? The answer is no. Every subsequent event auditor need not consider. Okay, why? Because in the subsequent events, some may be showing a material impact on financial statements, some may not be showing material impact. See, but from the management perspective, it is mandatory. Whether it is a small thing or a big thing, they need to account it, no doubt in that. But auditor will consider those events had it been known to the auditor on or before signing the audit report that would cause the auditor to change his opinion. Okay, why? Because as on the reporting date, if the auditor is knowing about the subsequent event, it is fine. Now, if the auditor is not having the knowledge and he had this known to the auditor, okay, about the subsequent events, if the auditor is given the information beforehand, it would result in changing his opinion. Whatever the report he is giving, opinion is given, that would change. In such a case, what happens? In such a case, what happens? Auditor need to consider its impact on the auditor's report. Okay. For that, they have given the first circumstances, the first situation, which is if the facts become known to the auditor. See, remember, you should write in the exam in the by using the same wordings. Okay, if the facts become known to the auditor between the date of financial statements and the date of auditor's report. Okay, so this is the first condition. So between the financial statements and between the auditor's report, auditor came to know about such subsequent events. In such a case, what the auditor will do? See, tell me, if you are in this situation, what will you do? It is very simple. Since you have not yet given the audit report, you try to obtain information about the subsequent events, perform audit procedures, obtain sufficient appropriate audit evidence, inquire the management how they have dealt with this situation, inquire those charged with governance whether the management is willing to do the adjustment or not to willing to do the adjustment. If they are not willing to do the adjustment, question the management why they are not willing, what is the reason behind that they are not willing to do the adjustment, isn't it? And finally, you consider the impact of that situation on your audit report. Since the audit report is not yet given, you try to give a report accordingly. Okay, if they do the adjustment, give unmodified report. If they don't do the adjustment and you feel it is material and pervasive or material but not pervasive, accordingly you can give a qualified report or adverse report. Have you understood this point? That is only being given here. In your books, nothing superficial has been given. Whatever we have discussed, that only will be given. Okay. See, the auditor should perform the audit procedures to identify the events that might require the readjustment. If material adjustment events are not adjusted for, or material non-adjusting events are not disclosed for, then the auditor shall ask the management to make the adjustments. Okay, so if the identified adjustments or the disclosures are not made, then the auditor will do the modification of the opinion accordingly, isn't it? Now coming to subsequent audit procedures. What subsequent audit procedures can be done by the auditor? See, first and foremost, as I told you, inquire the management about the subsequent events. What are those events? What happened? What like under what category they are doing the adjustment? Inquire the management, right? Whether they are willing to do the adjustment or whether not willing to do the adjustment. You inquire the management. Also inquire the management the procedure how they are identifying these events after the reporting period. See, after reporting period, all the transactions goes into next year. After the reporting date, see after your 31st, after 31st December, then whatever the transaction comes, that go to the next year. Anyway, it will be recorded in the next year. But management should have a mechanism that if these events happen, then it will be regarded as subsequent events. Okay. And similarly, try to also read the minutes of the meetings of the members of board of directors that has happened recently. Why? Because they would have taken some decision. Review the accounting records including the budgets, forecasts and cash flows and interim financial information if any. You obtain written representation from the management that they have disclosed all the information to you. Inspect the correspondence with the legal advisors. Review the progress of the known risk areas due to the change of the subsequent events. Consider the relevant information which has come to the auditor's attention from the sources outside the entity, including the public knowledge, competitors, suppliers, and customers, etc. Why? Because if any subsequent event happens, outsiders also will be having the information. Inspect the after date receipts from the receivables. Inspect the cash book after the end of the year end for the payments or the receipts that were accrued at the end of the year. Inspect the selling price of the inventory at the end of the year. Okay. Why? Because inventory is valued as per cost or NRV as on the balance sheet date. Okay. Subsequently, those goods are to be sold in the market. If after the reporting period these goods are sold at a lower value, then as on the balance sheet also they need to reconsider the cost or NRV, whichever is less, that part, isn't it? So these are all the these are all the audit procedures to be followed in a case of subsequent events. So all these audit procedures are also very very important. Try to remember. I would recommend you to remember at least 6 points. Okay, at least 6 points you remember. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 points are there. I would recommend you remember 6 points. Okay, so what is the 6 points? Audit procedures in case of ISA 560. Okay, that too for adjusting events. Sorry, not adjusting events. I'm sorry. It's not for adjusting events. It is a common point. Okay, this is case number 1. Now here you can observe that this has happened in this period. I'll show you. Okay, so this we are talking in this. Means before the auditor's report, the auditor came to know about. Before the auditor's report, the auditor has come to know about the subsequent events. There may be also another case. There may be also another case where audit has been completed. Audit has been completed. Report has been issued to the management. Report has been issued to the management, and now the auditor came to know about the subsequent events. That is case number 2. Okay, in this part, between this part is case 2. Okay, and this part is case 1. This part is case 1. Okay, within this period if the auditor come to know, then it is covered under case 1. If it is covered in this part, means auditor has come to the knowledge of the subsequent event in this part, in this area, in this part, then it is covered under case 2. It is covered under what? Case 2. Have you all understood this point? Now let us go to the text. Okay, so this is the second point. Between the date of auditor's report, and the financial statements were issued. Means audit report has been issued by the auditor to the management, and management has not yet circulated. Okay, issuing is nothing but management will further issue to the shareholders. Okay, so in between that date, if the subsequent events has been come to the knowledge of the auditor, what the auditor is going to do? Okay, see, once the audit report has been signed, auditor doesn't have any responsibility. Okay, so auditor is having no obligation to perform the audit procedures. Okay, but he need to be aware of the fact whether the management is amending the financial statements or not amending the financial statements, and what impact it would have on the auditor's report. He should imagine this. Okay, and now if the auditor feels that there would be a change in the auditor's report, he will ask the management to make the necessary changes in financial statements. Okay, the auditor will ask the management to make those changes. If the management makes, auditor is very very happy. He will gather sufficient appropriate audit evidence and he is going to give the report. If the management or the client does not amend the financial statement, in that case the problem arises. Auditor will ask the management not to circulate this report to the shareholders. Okay, have you all understood this? Next, see, this will normally be in form of asking the client to amend the financial statements, and if the management does not amend the financial statement, the auditors and the report has not yet been issued, the auditor will still modify the opinion. If the auditor's report has been forwarded to the client, the auditor shall notify the management and those charged with governance not to issue the financial statements before amendments are made. So management is having the old report. They will auditors will ask the management not to send this report to anybody. If the client issues the financial statement, then what the auditor will do? He will do something to prevent the reliance on his audit report. Now tell me, what can be done to prevent the reliance on the auditor's report? What can be done? Press conference, okay, or giving the newspaper that those who are in the position of the old audit report do not believe it, right? I want to amend it. Okay, such things can be done. Have you all understood? Now see, understanding part to very easy, but presenting this in the exam becomes very difficult. For that you need to have multiple readings. You read this content multiple times, then automatically good statements are going to be formed in your mind. Okay, now let us move to the third case. Now let us move to the third case. See, what is the third case is audit report completed, issue to management completed, and management also circulated to shareholders. I guess this side you can't see it. I will write here. So audit report preparation has been completed. Issue to management also completed, and management also circulated to shareholders. Okay. After all these three, auditor came to know about subsequent events. Have you all understood this point? That is the reason why here it is written after the financial statements are issued by the auditor. Okay. See, same point, auditor is having no obligation to perform the audit procedures in such type of cases. Okay. But at the same time, had he known this information on the date of auditor's report, he would have modified it. Okay. If the case is very severe, had the subsequent event known to the auditor as on the balance as on the date of preparation of auditor's report, he would modify he would change his opinion. If this is the case, then the auditor will involve, otherwise the auditor will not involve. Okay. Had it known on the auditor's date of auditor's report, auditor would modify the opinion, change the opinion. In such a type of severe cases only the auditor will involve. Otherwise, the auditor is not having any obligation to perform any audit procedure in these type of cases. Okay. Now, if the auditor want to involve, then what the auditor can do? Same matter, the auditor shall discuss the issue with the management, request the management to change the financial statement. If the management is not changing, inquire the management why the management is not changing. Okay, and then try to conduct the audit procedures on the amended financial statements and then give your report. If the management is not ready to change the financial statements, then the auditor shall ask the management to auditor shall do different activities which will prevent the reliance on his audit report. Okay, and see, in this case one more additional point is in this case, first and foremost, auditor will ask the management, if you have circulated to the shareholders, send the shareholders another notice saying that don't believe those financial statements, and after that you do your work. Okay, so this is what about your SA 560. Okay, next. So this ends your SA 560. Okay, see, whatever we have discussed, it is there here. The auditor should discuss the matter with the management, and then the auditor shall perform the audit procedures on the amended financial statement. Auditor should review the steps taken by the management to ensure anyone who is in receipt with the previously old financial statements are adequately informed. Issue new auditors report including emphasis of matter paragraph and other matter paragraph to draw the attention to the fact that the financial statement and the audit report has been reissued. Okay, you remembered ISS 706, emphasis of matter paragraph and other matter paragraph. You can put this. If the management refuses to recall and amend the financial statements, then the auditor shall do something to prevent the reliance on his audit report. Like I told you, press conference, or giving an advertisement in the newspaper, or issuing a public note. So this will ensure that who are in possession of these documents will not believe it. Okay. So this is all about our SA 560. See, in SA 560, we discussed 4 points. Not 4, we discussed 5 points. Point number 1, I'll do a summary of this. Listen carefully. So, try to memorize along with me. Point number 1, we discussed about the meaning of subsequent events as per IAS 10, means events occurring after the balance sheet reporting period as per the IFRS, and then as per ISA 560. And second point we discussed about what? Adjusting events and non-adjusting events. Adjusting events with examples, non-adjusting event with examples. And third point we have discussed about if the facts become known to the auditor before issuing the audit report, then how the auditor should respond. And fourth point we have discussed about if the facts are known to the auditor after issuing the audit report but before it is issued to the shareholders. And at last, fifth point we have discussed if the facts about subsequent events are known to the auditor after issuing the financial statements and the audit report to the shareholders, then what the auditor's responsibility is. These 5 points we have discussed, very very important from the exam point of view. Okay, so have you all understood? So there is a test your understanding question. Okay, once you go through it whenever you're having the free time. Now listen carefully. The next topic that we are going to discuss is our going concern. Next topic that we are going to discuss is going concern. See, in going concern, we are going to discuss about the meaning of going concern, and then auditor's responsibility. Sorry, not auditor's responsibility, pehle management responsibility. Okay, first we'll discuss about meaning and then we will go further with our management responsibilities and auditor's responsibility. Okay, very very familiar, very very easy, very very familiar, very very easy. Can anybody tell me what is the meaning of a going concern? Or whenever you're watching this video, please memorize yourself what is going concern, what is going concern. Can I say that going concern is a fundamental accounting assumption? Can I say it as a fundamental accounting assumption? The answer is yes. Why? Because going concern says that whether the business, the going concern is going to the going concern says that there is an assumption that the business is going to continue its operations in the foreseeable future. Okay, with that assumption, the accounts are prepared. Which means the assumption is that in the future also there will be existence of the business and accordingly accounting is done. Right? For example, say in the property, plant and equipment, you can see the assets are presented in historical cost concept. Historical cost method they are presented, which means total purchase price of the asset plus other capitalized expenditure minus accumulated depreciation, and then book value is shown. Now, if going concern is not there, why the assets will shown at historical cost? They would have shown at realizable value, isn't it? So since there is a historical cost concept, we take the gross value of the asset minus accumulated depreciation and then we get the net property, plant and equipment value. Have you all understood this point? But if the company is about to close, next year the company is about to close, in that case the assets and liabilities will be presented at a realizable value. Okay. Now on the books, the property, plant and equipment may be having 100 crores, but its realizable value may be only 10 crores. Have you all understood? The value of the property, plant and equipment, like purchase price of the asset minus accumulated depreciation, and then you get what is the net book value. Now this may be different from the realizable value. This will always be different from the realizable value. Okay, realizable value means if I sell that in the market today, what is the amount that I am going to recover is called as realizable value. Have you all understood this? Now this is the meaning of the going concern. And next I said that going concern is regarded as a fundamental accounting assumption. With this assumption we continue to prepare our accounts. Have you all understood this point? Now listen carefully. Now listen very carefully. Going concern concept, who should do assessment? Do you think the auditor will do the assessment? Now the point is, why the auditor will do the assessment? The auditor will not do anything. It is the management who is doing the business. So management should have a clarity that whether their business is going to continue or their business is not going to continue. Okay, and see, this assessment should be done on a continuous basis. Okay, it is not like that at the starting of the year, you have done the assessment. Okay, so at the starting of the year you have done the assessment and you have left and you are doing at the end of the year. Okay, or you are saying that I have done already at the starting of the year, now let me ignore it. Okay, let me ignore it. Why? Because in at the end I am busy with preparation of financial statements. Now, does this work out? The answer is no, it doesn't work out. It doesn't work out. Why? Because the going concern assumption may be appropriate at the starting of the year, but it may not be appropriate. It may not be appropriate at the end of the year. Okay, have you all understood this point? So going concern may be appropriate some years back, but now for the same business, going concern may be applicable, may not be applicable. We don't know. Now, with this assumption, the management should plan their business operations, right? So, management responsibility is to assess the going concern concept of their business on a continuous basis. On a continuous basis, it should be done. Now, if anybody asks the company that will your business continue? They should say that yes, sir, it is going to continue for so and so days. Now, now tell me, is if the management is saying that yes sir, in next 1 month our business will be there, is it okay or it is not okay? The answer is it is not okay. Why? Because by the end you prepare the financial statements itself, it will be, let us say, 31st March. Alright, if they are following from March to April, 1st April to 31st March, 31st March will be the last date. Okay, let us say it is 2025. Now, do you think that on 31st night your accounts will be ready? From 1st April shareholders will get that information? No. For finalization of the accounts only it takes a lot of time. Let us say you have taken let us say up to 4th April you have taken for preparation of accounts. Preparation of accounts. Okay. Now, if you are saying that, if the management is saying that our business will continue for 1 year, no, sorry, 1 month, 1 month. Now the 1 month has already been completed by the time you complete your finalization of the accounts. How will you share with the shareholders? It is like purely bluffing the shareholders, isn't it? So at least this assessment the management should do for 12 months. Right, management should be in a position to tell that yes boss, we are doing the business and our business will continue, and we are imagining that up to 12 means up to upcoming 12 months to pakka we are going to do the business. Now every time it may not be 12 months, it may be more than 12 months, it may be 15 months to 24 months, 36 months, it can be. But if the management is saying that no, we have done the assessment for upcoming 3 months, then immediately auditor should say that ये क्या चीज होता है? Will any business do the assessment for 3 months, 2 months? What, are you doing business or are you playing with your company? Okay. So if the assessment is done by the management about their business for only 1 month and 2 months, how stupid is the company? Now the auditor will say that boss, at least promise 12 months. If the management saying that no, we can't promise 12 months, then please disclose that, Baba. Okay. If you are saying that your business will only continue for 3 months after the reporting period, you tell that. You tell that, yes, my business will continue up to 3 months. My business will continue up to 4 months. My business will continue up to next 5 months. You tell that. But without telling, simply you can't say that no, my business will continue for 4 years, 5 years. Okay, so if it is continuing for more than 12 months, you should have some basis. If it is continuing for 12 months, there should be some basis. You should openly say that yes, I have done the so and so assessment, and based upon this assessment I feel that my business will continue for more than 1 year. But if you have done the assessment for less than 1 year, first go and do for 1 year, at least 1 year from the balance sheet date, and see whether your business is going to continue or it is going to stop. Okay. Now this all points whatever I have said, it should be done by management, not auditor. Okay, this should be done by whom? The auditor, management, not the auditor. Okay, see, management only should do everything. Management only should have a realistic approach towards their business. Okay, have you all understood this? Now see, I have already told you that if the management wants to close their business, they can tell that openly, saying that boss, we are going to close the business, and accordingly your preparation of financial statements will happen, which is called as breakup or liquidation basis. Okay, now this assumption which is made by the board of directors should clearly tell that why they are saying that going concern is appropriate, or why they are saying that going concern is not appropriate. Okay, that should be told in the balance sheet, profit and loss account, notes to accounts. Okay, have you all understood these points? Next. Okay, see here they are telling about management responsibilities. This is management responsibilities, and this is auditor's responsibilities. Okay, now these are very important from the exam point of view: the director's responsibility and auditor's responsibility. Okay, now listen, what is the responsibility? As we have said that directors are responsible to assess the company whether it is able to continue in the foreseeable future or not. Okay, in order to do this, what the management should do, how they should support, I said that if you are saying that my business will continue after 12 months, you should have proof for that. Okay, so that is the reason why the board of directors should prepare the forecast to help their assessment, which is up to for their next 12 months. Okay, now if there are any material uncertainties, then the auditor should clearly disclose in the financial statements that due to these uncertainties our going concern may be possible, may not be possible. Okay, like recently the Trump has imposed the tariffs on Indian products. Okay, now some of the businesses may try to stop their business. Why? Because it may not be affordable for them. In that case, they need to disclose that in the notes to account, due to so and so things we are about to close our business. Okay, now when the directors are performing their assessment, they should take into account the number of relevant factors such as the current and the expected profitability, the debt repayment, and the source of financing the projects. Next comes auditor's responsibility. I said that auditor's responsibility is only to obtain sufficient appropriate audit evidence about the assessment made by management. Management has made an assessment, auditor should have a proof, the auditor should have enough evidence about the appropriateness of that assumption. Okay, simply auditor cannot say that yes management you said that there is an assumption, so there is going concern assumption. ऐसा नहीं हो सकता. So इसलिए that is the reason why auditor should obtain sufficient appropriate audit evidence about what? Whether the management assessment is appropriate or not appropriate. See here, obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern base of accounting in preparation of financial statements. Conclude whether there is any material uncertainty existing or material uncertainty not existing, and then give the report as per SA 570. These are the auditor's responsibilities whenever this SA 570 comes into picture. Have you all understood this? This is the end of our SA 570. We are done with this. Okay, going concern. Remember this going concern concept, very very important. And next, in this the most important part is indicators. The most part is indicators. See, indicators means management is saying that yes, our business is very good. Now, simply the auditor should not believe it. Now, while conducting the audit, if the auditor come across any of some issues which cast a significant doubt on the entity's ability to continue as a going concern, then he need to verify that. Okay, let us say management is saying that our business is happy, everything is going good, but whenever auditor have seen the working capital is being diminishing year by year, whenever the auditor has seen the borrowings, there are a lot of borrowings, and banks, financial institutions, everyone is coming and asking the money from the company. How come the auditor can say that? How come the management say that everything is going good? So during the course of the audit, auditor's duty is to see whether there are any indicators to going concern or not. Okay, whether there are any indicators to going concern or not. Now, some of the indicators that say that the company's financial position is not good and they are at the verge of their closing of their business are, first one is net current liability situation. Okay, and the borrowing facilities not agreed or close to expiry of the current agreement, which means the management is not doing the repayment of it. Default of the loan payments. Okay, loans normally become repayable on default. The company may find it difficult to repay the plan. Why? Because it is not having the money. Next, unplanned sales of non-current assets indicates an inability to generate the cash from other means, and a non-current asset generate the income. Sale of asset will cause a decline in the increase and therefore the profit. And so many other indicators also has been given, like missing the tax payments. Why? Because income tax department may come and ask to stop the business if they are not paying the tax. Failure to pay the staff salaries. A negative cash flow from over trading. Okay, negative cash flows indicates what? Negative trading. Inability to obtain the credit from suppliers. Suppliers are saying that no, no, first give the money, then only we are going to give the goods. Okay, major technological changes. Well understood this. And some legal claims, if they become successful, then the management need to pay a huge price. Okay, now see, all these are called as financial indicators. Whatever we have discussed, uh, whatever we have discussed till here, I guess, till here it is what called as operating indicators. They are called as what? Operating indicators. And then loss of key staff, over reliance on a single product, customer chasing to trade or having cash flow difficulties, and then emergence of a successful competitor, and then uninsured or underinsured catastrophes. Now see, these two are called as other changes, other indicators. And this is these are the examples of what? Operational indicators. Operational indicators. Okay, and the above is called as what? Operating, sorry, these are called as financial indicators. I'm sorry, I have not seen this. These are called as financial indicators. These are called as what? Financial indicators, and these are called as operational indicators, and then it is called as other indicators. Now if these indicators are identified, then the auditor would be performing certain audit procedure. Okay, audit procedures to assess the management evaluation of going concern. Okay, first and foremost, auditor is going to evaluate the going concern of the management, and he will ask the management whether it has been done for 12 months. If it is not done, auditor will now ask the management to make the assessment for 12 months. Okay, and then consider the management assessment include all relevant information or not. Okay, these are the audit procedures when the auditor is doing the evaluation of going concern. And then comes auditor procedures to identify where there is a doubt over the going concern. Okay, now see how the auditor will identify that the going concern is not appropriately present. As I told you, indicators: reduction in the cash flows, reduction in the profits, reduction in the market share. These are all the indicators of what? That the company is or the business is not performing well. Then the auditor will get a doubt over the going concern of the company. Okay, the auditor will what? Get a doubt over what? The going concern of the company. I well understood this point. In that case, auditor need to analyze what? The latest interim financial statements. Okay, what are called as interim financial statements? Those financial statements which are prepared in between a year. Generally, financial statements prepared end of the year. Now, in between two balance sheet dates, if any financial statements are prepared, then we call it as what? Then we call it as Interim financial statements. So here the auditor should verify what? The interim financial statements to understand whether the going concern is there or the going concern is not there. Right? I'll tell you through an example. Let us say 31st March 2025, the financial statements has been prepared. Okay. Now you are conducting the audit. Now you are conducting, let us say, the audit in August. August 26, you are conducting the audit. You are conducting the audit on 26th. Now, as on the balance sheet date, if going concern is there or not, it can be identified to subsequent events. Okay, so let us say April, May, June. Let us say on 30th June 2026, financial statements has been prepared. Quarterly financial statements prepared. Quarterly financial statements. Now, this is called as interim financial statements. Why? Because this has been prepared. This has been prepared between two balance sheet dates, so it is called as what? Interim financial statements. Okay, so auditor will verify not only that. See, here the management need to make the cash flows to support their assessment. Here the auditor will verify whether those cash flows are appropriate or not. Now cash flows is a forecast, right? How the auditor will verify? He will verify the assumptions behind it. He'll verify what? The assumptions behind it, and he will see whether it is okay or it is not okay. So review the terms of the debenture agreements, read the minutes of the meetings that has been conducted by the board of directors, inquire the entity's lawyer regarding the existence of any litigation and claims, confirm the existence, legality and enforceability of the arrangements to provide or maintain the financial support with related third parties, and also assess the financial ability of the such parties to provide additional funds, and then review the events after the balance sheet date to see the impact on these type of activities. Okay, so these are the procedures that the auditor should follow. So these also can be followed. Okay, but you read it as a second priority. Okay, but some points we need to read here also. So review the correspondence with the customers for evidence of any disputes. Review the correspondence from the suppliers. Review the correspondence from the banks, and then obtain return representations. Okay. See, from this at least you should write. This is a mandatory point. Apart from that, you need to write at least 6 points. Remember any 6 points. Audit procedures. Remember any 6 points. Okay, remember, try to remember minimum 6 points. More than 6 points, if you could remember, it is well and good. Okay, so this is all about our concept of going concern. Now listen, these are the audit procedures. We have another part which is called as reporting part. We are having a reporting part. Okay, see, the first case is there is material uncertainty about going concern. Material uncertainty about going concern. See, if there is no material uncertainty, then need not disclose, then the concept of modification will not arise. But here, modification possible whenever there is a material uncertainty existing about going concern. Now, if this is existing and the management is disclosing this in the notes to accounts, notes to accounts, notes to accounts, is disclosing this, then no issues. But if he is not disclosing, management is not disclosing, then the problem arises. Auditor will become hyper and he will say that I am going to modify the auditor's report. Okay. If there is a material uncertainty exists, then the auditor may modify the auditor's opinion. So this is also important. Reporting part also important. Please do remember this. See, reporting implications. The auditor should modify the audit opinion if the directors who have not made the adequate disclosure of any material uncertainty. See, material uncertainty made, no issues. But if it is not disclosed, then the audit report should be modified. Have you all understood this? Now the auditor should issue an unmodified opinion with additional communication if the directors have appropriately disclosed the going concern uncertainties or prepared the financial statements on breakup basis. These are the reporting implications. Okay, have you all understood this point? Okay, good. So thank you so much. We are going to stop the video here. It has become a lot of big video. Why? Because a lot of information we have discussed. Okay, it has almost been 1 hour. Okay, then have a nice time. We'll meet again in the next video. Thank you.